Thank you for joining me on Mark's Concept Corner. My name is Mark Morano, account executive with Empire Life. I've created 6 Concept Corner presentations, each of which is a 30-minute live webinar where I'm highlighting one of the top sales concepts in the life insurance industry. There are 6 Concept Corners in total. Please reach out to me for more details and support. Also, if you could please like and comment with your feedback, I would greatly appreciate it. Thank you for joining me. Enjoy the presentation. Today we're doing annuity funded life insurance. So this is a very interesting concept. It's a great prospecting concept that really hits the opportunity to multi-generational, parent, grandparent buying for a child, grandchild. So very interesting concept. I think a lot of us can market towards this, and I like it. I think it's a great door opener for many. So probably a concept you're not quite as familiar with as the ones I've talked about over the last few weeks. So look forward to sharing this one with you. Next week is TFA Maximizer, which will be the 6 of 6. We again have the ADO launch on my YouTube channel, Personal Corporate Legacy Builder, Insured Corporate Concept, Insured Retirement Concept, Personal Corporate, and then lastly we did Thriving in the Family Market. So some wonderful content available for you, and again this one will be posted as soon as the meeting is done as well. So for an agenda, as always, we're going to do a quick Empire update. Then we will get into the concept itself, annuity funded life insurance, and how to build it on Envision. This one is a few steps, so I want to spend a little bit of time on showing you how to build the concept using our software and AdCalc. And then at 10 o'clock, we will stop as always, and if there's any questions, I'm happy to answer them. If anything pops up in your head during the session, Jordan is monitoring the chat box at the top right corner. You're able to put any questions in there as well. So quick update, as I mentioned last week, Term 25 has been launched by Empire Life. If you missed my Monday morning email, I will selfishly brag that I was a nice little piece I put together, I think, that really helps show the importance of buying personal insurance versus mortgage insurance. Gave you a lot of websites and links to the bank stuff that shows how far superior our mortgage insurance is. So a lot of advisors use Term 25 as a natural match to a 25-year amortization. So a nice marketing tool we have having the T25 available, which is available as a rider as well as a standalone plan and can be bundled with any of our other contracts. So well done, Empire. If you haven't seen my Monday morning, have a look at it. If you need me to send it to you again, by all means, just flip me a note. I'll forward it to you again. So Term 25 is now available and available on Envision 11.9. So make sure you have the latest version. Previous updates, ADO, of course, 10% bonus commission for seg fund deposits up to December 30th. Take advantage of a little extra incentive there. Paramedical services, as of yesterday, paramedical services are back up and running. So there will be a delay, there will be a backlog, but we are getting closer to a normal or new normal. So that's wonderful. And if you have any in-force CI policies with us, take advantage of the ROP on death, no underwriting offer available to July 20th. Now there's new simplified form available. And of course, the summer e-bundle bonus. Empire came up with this term e-bundle. What that means is bundling the EHQ and e-policy delivery. So the electronic health questionnaire and electronic delivery. The money that we save as a company is passed along to the advisor in form of extra commissions and a bonus for the summer. If you are writing term, you are getting upwards to 20% more bonus compensation, gross compensation relative to the market, and on par at 15%. So a tremendous amount of extra compensation just for using a superior product and process in fast and full. And then if you're able to use the EHQ under the non-med limits, you can qualify for the extra bonus there. So do take advantage of that wonderful incentive for the summer with Empire Life. Okay, so that was a bit of an update. So annuity funded life insurance strategy. So what we are looking for here is a strategy where we're going to pre-fund future life insurance premium with one payment. Typically, it's purchased for children or grandchildren by parents or grandparents, and as opposed to paying ongoing premiums for the length of the payment period for a policy, we are matching a limited pay par policy with a term certain annuity. So looking for a single premium deposit. So let me take a step back. Much of our industry historically has focused on child policies, typically smaller par contracts, 20 pay life pay contracts. which is perfectly fine. It keeps your costs down, sets up the client for later advantages in life to have life insurance in place. In the last number of years, especially since we've noticed where we've launched our 8-pay and 10-pay contracts, we have seen a gravitation towards a quicker pay option. So things like our 8-pay and 10-pay, where the difference between a 20-year premium and an 8-year premium haven't been dramatically different. So for a slightly bigger premium, we can have something quicker pay, which led us to this strategy, the annuity funded strategy, which allows those with the means, the financial means, to quick pay something where we can do it all in one shot. People like the idea of giving a gift in one payment. So at its most grassroots, we're looking at a potential grandparent buying insurance policies for a grandchild, where grandma, grandpa doesn't want to pay for the next 15, 20 plus years of an insurance contract and that type of a yearly commitment, where they can simply buy a quicker pay contract and use a term certain annuity to pay for the contract up front. So giving the full gift up front, and it's a set it and forget it, and there's nothing ongoing payment stream necessary. So for those of you that have grandparents, quote unquote, in your block of business, wonderful opportunity to prospect a new opportunity to introduce next generation to insurance and pass along a very lucrative gift, which we'll go through down the road in this presentation to help their grandchildren be set up for later on in life. So, annuity funded life insurance strategy. Pictorially, this is what it looks like. Here's your overview. Quite simply, step one, we buy an insurance contract on a child or grandchild. OptiMax Wealth, Estate Max, 8-pay, 10-pay, 20-pay is your most common products. Policy becomes fully paid up at some point, let's say 10 years, fully paid up. Then we will transfer ownership at age of majority. So at age 18, the policy is transferred. In the Insurance Act, we have special provisions where we are able to pass along ownership down lineage, so parent to child, grandparent to child or grandchild, without any tax implications. So if grandparent were to pass along the ownership at 18 to grandson or granddaughter, it passes along at the existing ACB, and there's no tax implications for that transfer. You know, unlike if you were to transfer to a third party, there would be tax implications to a transfer of ownership. So in this case, you are transferring grandparent-owned policy to grandchild when he's old enough to own said contract, and there's no tax implications. Step three, child is now the owner and no further premiums to pay because we've typically done a limited pay contract. And then down the road, the fruits of the contract is ever-growing life insurance contract and substantial cash value relative to premium paid as the years go on that may benefit the grandchild at various stages of life. So very simplistic contract design once you put some of the pieces together. Ideal client. So we always give this ideal client slide. In most scenarios, the parents have done a great job investing RESPs. They've maxed out government benefits. They've done all the stuff they're supposed to do. Grandparents still want to give a meaningful gift. And again, they can give cash or other type of monetary amounts, but typically we find these sales are for insurance believers. So they purchase insurance on themselves, they see the value of it, they own insurance on themselves and feel as though there'd be a tremendous gift and future prosperity by giving a contract to a child or grandchild. With long-term benefits and tax-sheltered growth, and understanding that any future taxation would not be in the hands of grandparent as would be in the child's hand once they take over ownership. So it's a wonderful gift that gives tremendous value without any sort of risk, any sort of large risk involved. So works well. And in terms of this concept, we're looking for something simple, one-time solution, guaranteed and convenient. We've done a number of these over the last couple of years, and the main point is always convenience and the guarantees of it. That just makes everyone much more comfortable in the overall presentation. Typically, the strategy works historically where the owner, insured, and annuitant is all the same person. So it's also known as a back-to-back, where we buy the annuity to pay for the insurance. That's a typical concept. But in this scenario, this concept, we're looking at insuring the grandchild. So the owner and annuitant is let's use the grandparent, and the insured is typically the grandchild. When we set this up, we want an annuity payment to match the insurance premium. So if we're choosing a 10-pay or a 20-pay, we are going to choose an annuity, term certain annuity, that matches the annual premium of the insurance contract. So we're working backwards a bit to see how much annuity we need to buy to match the annual premiums of the insurance. The pay periods and annuity match. I will note, small policies do be a little bit cognizant. The minimum annuity deposit has to be $7,500. We won't accept anything smaller than that. So you do have to have a bit of a minimum size to the premium, but we typically are able to do smaller policies fairly well. Both the annuity and the insurance contract are set up on annual payments. We don't do monthly. A couple reasons. It's only one time a year transfer from the annuity over to Empire. And why pay the monthly load if there's no reason to? So typically annual basis for the annuity as well as the insurance contract. And whenever possible, we have one annuity per one insurance plan just for convenience. But I will talk about in the next slide. We can do multiple contracts on one annuity as well. So that's how it looks. But exceptions to the one owner, one insured, or annuitant owner insured on the same contract is when there is an insurable interest, i.e. a grandchild. We can look at the owner annuitant being separate than the life insured when there's an insurable interest such as a child or grandchild. We can set that up that way. When doing so, we always want to have a contingent owner. It's important if the life insured, if the owner dies before the life insured, so before it's transferred over at age 18, we want a contingent owner. So typically parent of child is the contingent owner if it's a grandparent situation. We want a beneficiary on the annuity. So if the grandparent passes before a policy is fully paid, we want the money to end up in the hands of either the life insured or parent again, so that the money can be used to finish off the payment stream of premiums owed to the insurance company. We typically use one annuity for one contract, but there are scenarios where we would have multiple contracts. So grandparent buys for all 3 to 4 grandkids at the same time. This is possible, and it is definitely doable. We've done many so far, but you do need to be cognizant of a few things. We will only do one payment per year, so the annuity will only transfer one payment from the annuity to the insurance company one time per year. So we need to ensure everything matches. The pay periods need to match. So if it's a 10 pay, it's a 10 pay for all kids. Issue dates. The issue date must be relatively the same, if not the same day, but within 30 days of each other. So that when the annuity does do its transfer of premium, it's all coming at the exact same time, and we don't run into any grace period issues or lack of or lapse issues with the contract. So we can do one annuity for multiple premiums, but just make sure there's a bit of extra work in the setup, which again, myself and Jordan can help you walk you through and make sure it's all set up. But just be cognizant of that scenario. So this is the basic illustration that we have in our concept pieces, our marketing pieces that are available to you. We have used Martin as a case study. So Martin, to give you an example of the insured annuity, is a 67-year-old grandparent of 3 grandchildren, a boy, 2 girls. They're 6, 4, and 1. Believer of insurance, and has decided to buy a 20-pay OptiMax, where he's using paid-up additions and enhanced dividend coverage to buy $100,000 per grandchild. Martin plans to be the owner of the policy with his son as the contingent owner. So in case Martin were to pass prior to the 20 years being up, the grandchildren's parents are the contingent owner. To pay for this traditionally, so again, traditional means over the years we would just simply set this up on a monthly or an annual pay. In this case, to buy 3 $100,000 20-pay policies would be $153 a month. If you calculate $153 a month times 20 years times 12 months times 20 years, you're looking at $36,728 of total premium spent. Which again, very common sale, works quite well. It gives you a little flexibility of lower premium if that works to your budget. But in this case, Martin has the financial flexibility to look at something a little bit quicker. If instead of doing a monthly pay or an annual pay for 20 years, he could consider matching a term certain annuity to the premium. So if we were to work backwards and pay that overall premium, he would need to buy a 20-year term certain annuity in the amount of $28,123. This would generate enough money each year to pay for the $1,700 of annual premium required to pay for all 3 insurance contracts. He cuts us one check for $28,123, which then goes to purchase the annuity. The annuity then once a year would pay internally to Empire a premium of $1,738 in order to pay the 3 insurance contracts. The policies themselves would grow as they would normally. Doesn't make a difference in terms of the growth of the contract. And at the end of 20 years, the policy paid up like anything else. The term certain would come to an end, and the 20-year pay in the scenario would be fully funded, allowing for the simplicity of doing it all in one shot. I will note that there is a bit of taxation to Martin. In this case, $294 of the $700 would show up in a tax slip yearly. So where is the advantage to this? So for Martin in this particular scenario, he's looking at the opportunity to pre-fund the contract in one shot. The green bar represents the one-time pay of $28,123. The blue bars represent a periodic ongoing payment for 20 years. The difference up front is he has saved $8,605 of pre-tax money, or equivalent to 23% total savings. So for this individual, because he has the non-registered money available, he's going to cut a check for one-time premium, saving overall $8,600. And again, the convenience of having it all paid in one premium, one shot, and giving the gift all in one opportunity. So this brochure is a snippet from our Kids Start program, which I'll share with you a little later on to show your clients the benefit and why they would do this concept. Down the road, why would they purchase it in place? It has a lot to do with the cash value. So in this case, we had 3 kids, 2 girls and a boy, and look at 20 years down the road, the green box is the projected cash value. 20 years down the road, schooling, first car, first house, you're starting to build some opportunity for extra cash in the contract if they wanted to leverage it or surrender the contract. 40 years down the road, they've built even more cash value projected, so that it's available to them for a nice head start or kid start in life. So that was Martin as a case number 1. I didn't really get into the logistics of how to build it, so I did a second case study here for little Johnny. In this case study, I'm going to actually build it for you step by step and show you how you can recreate the numbers you can create the numbers for an illustration for your particular clients. So little Johnny's grandmother is Jeannie. Jeannie loves little Johnny and wants to give the gift of insurance to her favorite grandson. In this case, we have a healthy budget of $5,000 a year for 10 years. Little Johnny is 2 years old, and Johnny's mother is Jennifer. Jennifer is Jeannie's daughter. So I just want to make sure we know all the parties in this particular situation. The setup, Grandma Jeannie is the owner. She owns the insurance contract on little Johnny, and we're setting up the mother, Jennifer, as the contingent owner, and Grandma Jeannie is the annuitant on the annuity contract. Johnny, of course, is the insured, until he's age majority, at which point we can change over the ownership. And Johnny's mother, Jennifer, I would set up as irrevocable beneficiary. So let me just explain this point for a moment. If we have the grandma as the owner and Johnny is the insured, at some point we're going to give Johnny this contract. So let's say he was 18, we give him the contract. If we do so, he's now 18 years old and has a substantial amount of cash in his contract. And let's just say at 18, not overly financially fiscally responsible. By making Jennifer, the mother, a irrevocable beneficiary, she must sign off on any sort of surrender of cash value or changes to the contract. Because the policy is fully paid, the only thing that is accessible is surrender of contract. So I like adding irrevocable beneficiary of the parent, assuming everyone gets along and the family is well-meaning. That irrevocable beneficiary gives the little bit more control on Johnny not just blowing up the contract at 18 to frivolously use his money. So it's a nice little additional benefit. I like a nice little setup I like putting on there without needing any more insurance trust or anything more legal in setup or cost. And of course, Jennifer, the mother, is the Benny to the annuity, just in case Grandma Jeannie passes before the 10 years is up. So the money could go to Mother Jennifer to continue to fund the 10 years worth of insurance. The product we have chosen in this case is State Max 10 Pay. Coverage in our budget gets us about $250,000 of life insurance, which is comprised of premium of $4,770 plus the maximum ADO of $345, giving me a premium of $5,115. Total premium of $51,150 over a 10-year span. Please note they do anticipate to pay for full 10 years at the $5,100 a year for 10 years. But with the flexibility of ADO, please note that this contract will be fully funded after 8 years of payment. So if they did want to stop paying for some reason, there is enough cash value to pay up the last 2 years of the 10 pay after 8 years. So again, the power of having ADO on your contract. So first step is we create a basic illustration. So this is right from my Envision software. We have Ginny, the grandmother, is the owner. We have life insured Johnny, he's a 2-year-old male. A little note with Empire, a little competitive advantage you should all know as well. He's considered a juvenile now, but we automatically assume he's a non-smoker at 18, which is a big competitive advantage for Empire. We don't have to worry about smoking changes or status changes at age 18. Of course, they are smokers, their job, and they must tell us. But if they're not, we automatically assume non-smoker at 18. So that's a nice little Empire advantage there. Product is a state max 10 pay, ADO 345, $250,000 10 pay equals $4,770. So total premium of $5,115, as I mentioned in the last slide. Now, the second step to this is we need to build an annuity. So if you haven't done an annuity quote with Empire, here's your first look at it. So empire.ca is the basic website. We go to the advisor section. So empire.ca, advisor, investments, investment products, immediate annuity. No password required. You simply click on immediate annuity and it'll open up your ability to quote. This is a snippet of what it looks like. We input client's name, date of birth. So grandma is the annuitant in this scenario. So that's her date of birth. We are purchasing a term certain annuity. So we just want it for a certain period of time. We're using non-reg funds. We're doing a 10-year guarantee. And I'm trying to match desired income of $5,115. And of course, we have an annual pay, which will allow me to match the annual pay of the insurance contract. We would then press submit. And it gives us our annuity quote. So I'm going to build one of these quickly in a moment, but I just wanted to show you the steps. So here, in order to fund $5,115 for 10 years, the lump sum deposit now becomes $49,694.78. Instead of paying 10 years of $51,000, they're paying $49,000, let's say $700, with a small bit of taxation. So the annuity now saves them a little bit of money up front by paying it up front versus over the full 10 years. Of course, now we use our AdCalc, which again, I'm going to show you this in a moment. We plug these numbers all into AdCalc, which again is our concept software we've talked about the last few weeks. AdCalc then produces this very client-friendly concept illustration, annuity funded life insurance for little Johnny. And it gives over our basic assumptions page. So life annuity, we have child, we have the premiums. It shows you the savings of $1,455. This would be the savings of paying using the annuity versus the paying the annual premiums of $5,115. It then gives us a printout. And again, I'm not going to give you an eye test here. I'm going to highlight some of the numbers on my next slide, but we're basically comparing the annuity and then the cash value and the death benefit of the insurance. The yellow bar comes in automatically. That will be the crossover point of where the cash value is above the premium paid. Then we just look at the various years. So this is where the point of this all comes along, is the long-term benefit and value of the insurance. So what is Johnny going to do with this contract down the road? Because Grandma Jeannie was a believer in insurance and thought it'd be a great opportunity to set him up for later on in life. The cash value tends to be a big focus of the sale. So where he can use this cash value at different phases of his life. So for example, at year 20, still in school, maybe he has some debt or some loans that wants to be repaid or some schooling paid for. He could potentially surrender or borrow against his contract at $63,000. If at year 35, he hasn't used his cash at all yet, he's now built it up or projected to $152,000, which could be used towards a first house. Maybe at 40 years down the road, he's trying to expand and open up a new business or an expansion of existing business. He has $200,000 of cash value in his contract. Year 55, he's got $457,000 projected cash value, which could be used to help his own kids potentially for weddings or their own schooling or whatever it may be. Age 65, if he hasn't touched his policy at all, is projected to have $752,000 worth of cash value at this point, which could be leveraged for retirement purposes. So, Grandma Jeannie's gift many, many moons ago provided a big chunk of value and growth in this contract. Not to mention he has 1.2 million of projected life insurance by age 65 as well. So a tremendous benefit and value down the road for our client. Now, the second part of this, which I don't think is talked about nearly enough, is the cash payment dividend option. So if the clients decide their policy has grown to a big enough level, you have the opportunity to switch your dividend option from buying more paid up additions and more cash value to taking a cash payment of your annual dividend. So here's some examples of the random years. So at year 20, for example, if the client decided I have enough life insurance at $451,000, they could turn on their annual dividend payout to take out $1,758 a year, and it will continue to grow marginally for cash for life. If we wanted to look at year 30 as an example, and they have enough life insurance at $585, we have now an annual dividend of $2,711, which can be paid out in cash. Year 40, year 50, year 60, again, year 70. If they haven't turned it on at any point, here's your flexibility and options down the road to help supplement maybe retirement income or just income in general, where they can decide to turn on the cash payment dividend option, allowing them to take a stream of income down the road. This is taxable income above once we've used up our adjusted cost base. But again, it's money that's available to be used as part of retirement or income or lifestyle in general, whatever is required by the individual. So not only do they have cash surrender value to help them grow it and build or put towards any part of life event where there is some necessity, we have the cash payment option, which could be turned on at some point as well. So that was the general concept. I want to just quickly, and I've already pre-filled the stuff, so it should be pretty quick. I want to build it for you and show you how to build this yourself. So on Envision software is my first screen. So I've already built the illustration. So I have little Johnny here is my first tab. So he's the insured, not the owner. So it's important when you do a child policy, you can't make him the owner because he's only 2, and I'd get a red error message over here. So I take off owner, and I put little Johnny in, and then I would add a second life, which I've already named Jeannie, and I'd make her not the insured but the owner only. And again, she's a female 70 in this particular case. So I have 2 lives here, and 1 insured, 1 owner. I then go to my coverage tab. In this case, I've used paid up additions. I'm using a 10 pay for $250,000. I've used maximum ADO, and it gives me $5,115, 115 of annual premium payable over a 10-year span. From there, I would then press, I would normally press add calc, but I need to first do my annuity quote. So let me jump into my annuity quote here. My annuity quote is not opening. Weird. Oh, there we go. Okay. So we have a client. Here's her date of birth, 7 years old, as I said, female. We're choosing a term certain annuity in this particular case, not a lifetime annuity, but a term certain for a set number of years. We're using non-registered funds. We are trying to get a desired income of $5,115, and we're doing an annual frequency, again, to match the annual pay of the 10 pay. I would then press submit, and it would give me my annuity quote, which is what I have here. So again, it gives me my single premium deposit of $49,700 for an easy rounded number, and that would then payably once a year at $5,115. We would do an internal payment to Empire Life. It's all internally transferred, and it would pay each of the 10 years for the 10 pay contract. Okay. And then as we get into the software, just quickly on AdCalc, we would then open up our illustration. It would take our 10 pay quote and open up AdCalc, hopefully quicker than this. Give me a moment. AdCalc. Just going to carry my numbers over. Just bear with me a moment as I do a little song and dance here. Come on. Maybe a little slow due to the internet connection. Come on. Give me a moment. Sorry to waste time. I'm going to be over my 10 o'clock limit here. doesn't seem to want to open up. So I'm not going to wait for that. But again, the numbers it's a plug and play. I've already shown you the inputted numbers, and again, Jordan and I are always available and able to help out as well to help you run through these quotes. But you basically need to know how to do the 10-pay quote is the priority, and the annuity quote to match the premium of the 10-pay, so we can internally set this thing up going forward. In terms of helping you market the concepts, I'm having a difficult time here. Oh, there we go. We have the Kids Start marketing program. So if you want these Kids Start books, they're nice, they're client-friendly brochures, able to help your kids start. We call the Kids Start Children Program Wealth Transfer Strategy. So that's available to you that you can use. I'm going to send you a couple of links as well that if you wanted a very short 2-minute video as to why you would buy whole life insurance, we have this on our Empire Life YouTube channel that is available to help to show why anyone would buy whole life insurance on a child. And it references the Kids Start whole life insurance contract. Very well put together video that was just created in May. So take advantage of that. And for those of you, I've never mentioned this, I should have mentioned this on previous presentations. We have a great website called Life and Money Matters by Empire Life. It's a third party it's an Empire website sponsored by Empire, but it's a landing page that you can use to help market for your clients. So if you want to take a video or other great marketing pieces, go to Life Stages and look at various stages that the clients may be there, maybe in, which could give you marketing ideas of how to prospect and show them various information that pertain to them directly. So today, as a review, sorry for those technical difficulties. I'm not sure what happened there. Too many people on the internet at once, I guess. Today, what I looked at is the strategy itself, annuity funded life insurance, great prospecting tool for typically looking at grandparents or parents buying for children or grandchildren. Great prospecting tool, even from a conversation starter standpoint, something to look at. Went through the target market, went through some case studies and some marketing material. As always, Jordan and I are always here and available to help out whenever possible. So you're of course welcome to reach out. This was recorded and will be sent to you as a link to my YouTube channel, which you're able to look at and review if you wanted to look back at anything and any information. So that being said, I am going to wrap it up there. Close out of here and go to the presentation itself. And is there any questions that Jordan answered? This is slow. Nope, doesn't look like there's any questions. So at this point, I'm going to say thank you to everybody for your time as always. I appreciate you jumping on the call, and we'll see you hopefully next. We'll see you next Tuesday, same time, same place.